Let's kick off this morning in Switzerland with Giovanni Staunovo, commodity analyst at UBS Global Wealth Management. Giovanni, I suppose the question I'm asking myself is when will oil markets start to move from tightness and shortages that we've seen to supply outages that we're hearing about, the cliff edge that people like the Mr. Curry that is telling us about. But when do you think that shift starts to happen?
Good morning, Joe. Obviously, I was also predicting that by now there should be shortages and it should be visible in a price. I was a bit too pessimistic when it comes to the price directions, but essentially what we know is that there are two forces helping currently: China with the reduced imports and the US exporting large quantities of oil, record amounts. It's the largest exporter now, even more than Middle Eastern players. Obviously, they are disrupted. Once these US supply exports slows down because the SPR releases are ebbing off, I would expect a price increase. So I would still call by the end of this month, we should see a stronger impact on the price dynamics if the strait is still closed.
And I mean, the price dynamic, the actual idea that there are outages that we're already hearing, for example, that Argus has reported that there's no ultra low sulfur fuel oil in Fujairah at the moment. These sporadic outages starting to appear. A friend of mine told me that flying back to Dubai the other day from Glasgow, they had to stop in Manchester to get jet fuel.
So essentially, the global market is influenced by two benchmarks, WTI and Brent, and they have a dominance on what's going on in financial markets. And at the moment, yes, you have some products having some issues, but Brent, for example, is still benefiting from the higher imports coming from the US, and there is also higher exports coming from Kazakhstan. This is easing the situation, but as pointed out, I still believe that some of these inflows from the US will start to slow down, and then the situation will also tighten in Europe. So still looking for prices moving above 100 over the coming 3 months for Brent.
We had the news yesterday of US inflation numbers, CPI coming in at 4.2%. It kind of got brushed aside. I mean, this is a bionic number by any historic standards, double the target of the Fed. And yet it seems that we're kind of being slowly frog boiled into believing that this isn't such a big deal. Feds, central banks won't have to fight this. What's your outlook for this creeping into being part of the wider narrative and in other times would have had a big bearing on the direction of travel of monetary policy? Is this time going to be different? How do you see this feeding into the economic outlook for the second half of the year?
Here, clearly, we need to make a distinction by region, talking about Europe and the US. European central banks have focused on price stability, so higher energy prices, higher inflation, more pressure to do something. At the same time, the economic situation was improving, but is not really strong like in the US. So it's a bit, by some, called as a policy mistake because there is price pressure, but at the same time, higher rates will slow down economic activity. So there, our economists are already looking for rate hikes for the ECB, for example. We target now 2 rate hikes. At the same time, on the US, you have the double mandate, full employment and price stability. So you have price stability, which is a bit too out of reach at the moment, or inflation numbers a bit too high. At the same time, you have the unemployment market or the employment market, which is quite strong. So if we take last week's payrolls data, they were quite solid. So
I mean, those two things combined, 4.2 and bionic jobs data, is get those interest rates up at the next meeting. That would be a normal course of action if you take the average Fed policy of the last 50 years.
I would agree on that, but the group, the FOMC members, are still advocating to be more patient to see how the situation evolves. Definitely, the market is pricing in rate hikes. As you point out, that's what the history would have told us. Our economists are a bit more positive. They expect the Fed still to cut rates, but it has been delayed further down the road. It's now next year. Originally, we had 2 rate cuts this year. Now it's 2 rate hikes next year. So at the moment, there is still the expectation that the US economic growth outlook will moderate a bit from a strong pace, and that doesn't force the Fed to hike interest rates despite the price pressure. But definitely, if the situation keeps going on, that the US economic activity remains solid and pressure on the prices remain, then obviously there is a risk of a rate hike also in the US. Not our base case at the moment.
Giovanni, looking at that question from a European point of view, there seemed to be a lot of concern earlier in this conflict. We're 100 plus days into it, that Europe was going to probably run out and see outages in jet fuel in certain parts of Europe, and particularly airlines that were unhedged would be facing bankruptcy. What's the outlook, do you think, just looking at that as a part of this question, Europe outages this summer, jet fuel in particular?
It's always surprising how much impact prices have and incentivize refinery. So this massive increase that we have seen for jet fuel trading temporarily $200 a barrel has just incentivized a lot of refinery to change the mix on the production side. So they produce a bit less of distillates, less of gasoline, and more of jet fuel. And with that, the supply situation looks better for jet fuel. However, we don't produce the molecules. We have still the same molecules. So we fix one element of the barrel, but we don't fix the other parts of the barrel. So we are just temporarily surviving a few more weeks. But the situation remains extremely concerning that at some point we are moving, as you just said, towards the cliff. And if the supply situation is not improving, at some point there will be a repercussion coming to us.